Welcome to M&A Talk, the #1 podcast on all things related to mergers and acquisitions. Brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. We bring you exclusive interviews with industry experts in business sales, valuation, private equity, investment banking, and more. It's our mission to provide you with insight and guidance on how to build your company's bottom line and maximize value for eventual sale. Here's your host, Jacob.
Welcome to M&A Talk. My name is Jacob, president of Morgan & Westfield, and your host of M&A Talk. And joining us today, we have Jeff Hooke, senior financial lecturer at Johns Hopkins Carey Business School and a senior advisor at Focus Investment Bank in Washington, D.C., joining us in the show. Jeff was previously a managing director at Focus Investment Banking and also a lecturer at the Emerging Markets Partnership, a $5 billion private equity group. And he was a principal investment officer of the International Finance Corporation, $30 billion private sector division of the World Bank. He's the author of 5 books on finance and has spoken in front of many university and industry groups around the world. And his most recent book, which we'll discuss on the show, is titled The Myth of Private Equity. Jeff, it's good to have you on the show.
Thank you. I'm glad to be here.
So, Jeff, the topic today is private equity. We'll talk about your investment banking career another time. What's your experience in private equity before we jump into our 500 questions here?
Well, in the course of my rather lengthy career, I had a number of jobs as an investment banker doing deals, but I also had several jobs as a private equity or private investment investor for a very large institution. So I've got experience directly in private equity as well as selling companies to private equity funds.
How big was that? Of course, they raised multiple funds, but any kind of industry focus and size focus and size of fund, can you give us an idea here?
Well, the last private equity fund where I worked had a total of $5 billion under management in several funds. As an investment banker, when I sold companies to private equity or leveraged buyout funds, the deals might range in size from 25 to 200 million.
And any particular industry focus?
No, the industry was agnostic, really. However, as we'll discuss later, the profile of a leveraged buyout fund target is usually a low-tech company that also has very few debts and a consistent record of profit.
We'll get into that in a moment. Let's back up and define what private equity is for those that are listening. What exactly is private equity? I think we know what public equity is, but what's private equity?
So, of course, public equity would be buying stocks on the stock market. Big name companies like Amazon, Exxon would, of course, be something that everybody listening would recognize. Private equity, on the other hand, is when the investor, usually a large institutional investor like a pension fund or a university endowment, decides that it wants to try to beat the regular stock market. So as one way of doing this, they try investing in private companies or private equity. So a private company, of course, is not listed on the stock exchange. So these big institutions working with private equity funds buy into private companies with the hope that later the private company will either sell out in a merger or do an initial public offering, and that over the course of that investment, the institution will make more money than the stock market.
Do they invest directly? If not, why wouldn't they just invest directly in companies?
90% of them do not invest directly. The staffs at big pension funds or giant university endowments, the staffs really aren't equipped with the type of skills needed to buy into private companies, to manage the debt load of these private companies, to engineer the process of eventually taking the companies public or selling them in a merger deal. So the actual investment process in the private equity realm is delegated to hundreds of private equity funds where the managers of the funds have that kind of experience.
And there's what now, a few thousand PE firms, roughly?
Yeah, there's over 4,000 private equity funds, and it basically matches the number of actively traded public companies. It's quite remarkable.
How big is the PE world, by the way?
I have the numbers sort of in my head. So if you look at the value of the U.S. stock market, it might be $40 trillion, of which, say, 5 or 6 companies, Facebook, Google, and a few others, are about 25% of that value, 10 trillion out of 40 trillion. The private equity business might be 3 or 4 trillion. So it's perhaps 10% of the value of the stock market. Still huge. No question. It's gigantic and growing.
So the GDP is what, at about 20 trillion, and if PE, private equity, is 4 trillion, it's about 25% of our GDP, roughly.
Well, the GDP is an annual measurement of income, whereas the private equity income would be a fraction of GDP. And, let's say we think the stock market's trading at 20 times earnings. So, the stock market earnings might be 10 or 15% of that. So it's big for sure. It's not as big as the publicly traded stock market. It's still big.
Do we have numbers on total revenue of PE firms?
No, as you know from just the name private equity, a lot of this information is hush-hush and confidential. So it's tough to pin down the number of employees the private equity industry has, or its total revenue, or its total profit. Suffice to say, it's very large.
And the first PE firm, was it in the 70s or 80s?
The first prominent fund where you had some major institutional investors as just opposed to wealthy families buying into the fund was Kohlberg, Kravis, and Roberts, which started in the early 1980s. So that was the prototype that's been copied hundreds of times.
Got it. Leveraged buyouts, of course, in the 80s and early 90s. Eventually that term, I think, fell out of favor. And today, are they called PE firms, private equity groups, PEGs? What's the preferred moniker?
Private equity firm, private equity fund, and about 65%, or roughly 2/3 of the business, is leveraged buyouts. And then you might have 20% that would be venture capital, which, as many of your listeners know, would be funds that invest in startup or very young companies that seem to have a lot of promise. And then there's another 10 or 15% in growth capital and distressed funds, which be more specialty oriented.
So VC, of course, venture capital funds, that is equity that is private. It's normally a minority position. Just very briefly, what are the other major differences between private equity and VC capital?
Well, venture capital, not all venture capital deals, but most venture capital deals tend to have a young company. It usually, but not always, has a technology orientation. And as a young company, it may not have a long history of making money. In fact, since they're young, often they're starting off their corporate life losing money. Whereas the leveraged buyout business is totally different. It's low tech. So you want a furniture maker or a paint company or something low tech. And it has been around for 15 or 20 years making money. And the reason for the difference is that for the leveraged buyout funds to borrow a lot of money, the target company clearly has to have a long history of profits. Otherwise, no lender is going to lend money to a company that can't make a profit. So venture capital, of course, the young companies cannot borrow money. They don't have a very long track record. Whereas in the leveraged buyout realm, you're looking at companies that have been around 15, 20, 30 years, low tech, and making good profits.
Got it. So hence the name leveraged buyout, meaning the PE firm raises the money and they might put in 20% cash and then have the seller carry a note and then the remainder being raised through debt capital. And we'll get into the structure of that a little bit later on here.
Precisely. It's almost as if you're buying a house, which is good collateral and may have a history of being rented out or whatever. Usually you, the buyer, can borrow 70 or 80% of the purchase price of that house. That kind of leverage, however, is unusual in the corporate realm.
And so who are the PE firms, private equity firms' customers?
The PE firms' customers are very sizable pools of capital. I mentioned a couple of them. State pension plans, university endowments. You have sovereign wealth funds like Saudi Arabia, Norway, and China investing in private equity funds. And then you have some major foundations investing as well. So these are all sizable pools of capital whose main objective, of course, is preservation of that capital. They don't want to lose money. But on the other hand, the managers of these giant pools of capital want to try to beat the stock market.
And what are their typical return expectations, these limited partners?
Over long periods of time, they would like to get an 8 or 9% return per year. That is their ultimate objective with minimal downside. So they might put 60% of their portfolio in publicly traded stocks or private equity or hedge funds, something that has sort of a risk orientation, and then the other 40% of the portfolio might be conservative blue chip bonds and treasury securities. So they're willing to take some moderate price risk on 60% of the portfolio, but they want to avoid downside on at least 40%.
And even some of these really big limited partners, they might invest in dozens of different PE funds, right?
Exactly. So if you look at, let's say, the state of New Jersey, which has 70 or 75 billion in assets, I mean, their private equity fund portfolio is probably over 100 funds.
Wow, that's incredible. And so the average PE firm, how many limited partners might they have?
Your bigger private equity firms might operate multiple funds, 5, 6 LBO funds that are staggered every few years. They would start another one every few years. But easily in a single private equity fund that's sizable, you could have 15 or 20 institutional investors of the kind we've described.
And so when the PE firm needs the money, they'll do a capital call. They'll call the money from the limited partner, and then they'll put that money up for that particular transaction, and then they'll raise the rest of the money through the debt markets and then also directly through this seller.
It's exactly the way it works. So you've got, as you pointed out, an equity down payment of 20 or 25% of the purchase price. You might have a seller note for another 5 or 10%, and then the rest is borrowed funds.
For the sellers that are listening, the business owners that are listening to this show, this is very important information because, well, Jeff, in your estimation, if you own a middle market company, what do you think the chances are that you're going to end up selling to a private equity firm?
If you fit the description of the LBO profile, which is low tech, consistent moneymaker, no real sizable debts, I'd say the chances of selling to a private equity firm are probably pretty good. I'd put it at 30 or 40%.
And what would the other 60 or 70% be?
Well, the others would sell it to a competitor usually. So those are clearly the most logical buyers. Such a business would be your direct competitor or someone that operates the same business in an adjacent market.
Wonderful. And so, again, to the owners that are listening of these middle market and even small market companies, I know some of the PE firms might go down to and invest in companies with an EBITDA as low as $500,000 or $1 million. We'll kind of dive into the specifics here later on and how this might impact you and how they might structure the transaction. But before we do that, let's briefly talk about the funds. So how do the funds operate and how does the relationship work between the general partner, the private equity firm, and the limited partner or their investors, such as the pension funds?
So the general partner, which is usually a team of people like myself, investment bankers who know how to find deals, close them, and finance them, is usually run, like I said, by a team of investment bankers, people like myself. And the limited partners putting up the money don't have a lot of say in how the fund operates. They may have some veto power on specific deals, But generally, they're relying totally on the private equity fund over a period of years. The fund life might be 10 or 12 years. They're relying on them to identify the deals, price them, borrow the money, and eventually sell them. The institutional investors, for the most part, don't have a lot of expertise, so they really don't have the ability to critique many of the decisions that the private equity fund manager makes.
How does leverage change the situation or impact the situation and the returns? And why is leverage used?
The whole point of a leverage buyout is that a levered investment with a lot of debt on it, if the market overall does well, either in M&A or stock market, the effect of leverage will enhance the return. So that fundamental principle underlies the entire LBO business. Leverage enhances equity returns. And if you just use a simple example of, let's say, buying a house for $1 million, if you put down 20% at $200,000 down payment, and the house increases in value 20% over a year, if you only put down 20%, you have a 100% gain because the house that you bought for $1 million is now worth $1.2 million. So you've got a 100% return on your equity in a year. Now, if you had put up 100% equity, you bought the entire house for $1 million and borrowed no money at all, after a year, your return would be 20%. That's still pretty good in my opinion, but it pales next to 100% the return you got from borrowing all that money.
As a reminder, why don't the venture capital firms use leverage?
The VC firms cannot use leverage because lenders are not going to lend a lot of money to a company that can't make a profit. So if you look at a company like DoorDash, for example, loses money, you're not going to find a lot of banks or other lenders that want to provide money to a company that loses cash. So it's just like, who would you rather lend money to as a personal investment? Would you lend money to a person that has had the same job for the last 30 years and has got a steady income? Or do you want to lend money to someone just getting out of college who might have a bright future but has no history of making money? You know, most people are going to prefer to lend money to the former, not the latter.
And the private equity firms primarily make majority investments. Why do the venture capital firms not make majority investments?
I think for the most part, the venture capital firms think that management is critical. The founders, the inventors, they want them to stay around. They want them to be in control. Because the company is so young, you really can't transfer in and out with new executives for a company at that stage of its development.
And so the VC model is swing at 10, strike out 8, hit 1 home run and 1 triple? Is that about how it works out?
I think that sums it up very well.
And how would you sum up PE, private equity?
Leverage buyouts, because of their low-tech, solid profit orientation, would have a slightly higher hit rate. So they might have 1 home run, a couple of doubles, and then they might have 2 or 3 singles, and then they might have 3 or 4 bankruptcies. You say, well, I thought you said these companies are conservative and solid. Yeah, but some of them are going to have bumps in the road and can't handle all the debt they borrowed.
And how many companies might a PE firm invest in one fund?
Generally speaking, the bylaws of a private equity fund sort of require that the fund not concentrate its investments in just a handful. So 10 or 15 would probably be a good number to think about as an average number of companies per fund.
And so their goal, and again to the entrepreneur listening to this show, their goal might be to purchase your company at, say, $100 million today, and then turn around and sell it at $200 million in 3 years or $300 million in 5 years. How might a typical transaction look like? So for you running a PE firm that had $5 billion under management, if you bought a company for $100 million, what would be a single versus a double versus a home run on that transaction for you?
A single would be a deal that after all the smoke cleared and the debt was paid off and the company was sold. Single might be 8% internal rate of return per year. Now, a double might be 15 or 20% per year. And a home run might be 30 or 40% per year.
Why IRR, or internal rate of return? So this sounds like it's something specific to private equity. We don't see IRR in public equity markets, but why IRR?
No, you see the internal rate of return quite a bit when you look at how the overall market is measured. So, the stock market for the last 10 years, people throw around like the IRR of the stock market might be 13 or 14% for the last 10 years. And the IRR is often described as the yield. So if you look at a fixed income investment like a U.S. Treasury, the yield for the U.S. Treasury 10-year might be 1.5% today. Well, that's really the IRR of the Treasury based on its current price. So sometimes there's different words for the IRR, but the rate of return and the yield and those kinds of words are often the same thing.
And so it's time sensitive. The fact that it's time sensitive, how does that impact the PE firm's operation of the business and their objectives?
So the PE firm, as I mentioned, usually has by law or by contract a 10-year life and sometimes a 12-year life. So the managers of the fund look in the mirror and say, well, I only got 10 years for this one, so it takes me 2 or 3 years to find 10 companies to buy and negotiate the purchase and raise the money. So there goes 2 or 3 years out of the 10. I then need to hold on to the companies for a few years and try to improve them if possible. So that's another 3 or 4 years. So now I'm looking at year 7. And then trying to sell the deals takes 2 or 3 years. You just can't sell them overnight. So the PE fund is running on a clock. So they're under pressure to put out the money, develop the companies, and then flip them.
Who are the PE people, by the way? Are they finance guys? Are they operational girls? The people that are running these firms, what kind of backgrounds do they typically have?
I'd say at least 2/3 of them would be people that have had Wall Street jobs. Usually they're investment bankers at one of the bigger investment banks out of New York. So they've got a good experience in finding deals, pricing them, negotiating them, and then eventually, as I mentioned, selling them. And so that's about 2/3 of the management team at these big funds. And then there might be, say, out of the next third, you've got people that may have worked at the big management consulting firms like McKinsey or Bain. And then you have some people that were executives in real operating companies that might parachute into one of the purchases for a couple of months to try to figure out how to improve them.
How do private equity firms use various expertise within specialties? Whether it be in conducting due diligence, financial due diligence, legal due diligence, operational due diligence, HR, etc., or in terms of actually operating the company?
Well, let's look at the purchase process first. So let's say that the private equity fund has identified a target and gone through the dating relationship with the target, and now they've signed a contract that says the fund will buy the target. And then it sends in a SWAT team, which would actually be a combination of experts, finance, legal, IT, management. So they would, send in this team of people to investigate the target and make sure everything the target has sold them is true. That's called due diligence. So let's say you're buying a target that makes auto parts. You would, as the private equity fund, you would, besides having all the legal and HR and IT people go in and kick the tires, you would probably hire somebody who had worked in an auto parts company who's now retired or acts as a consultant. And that person would go in and check all the industry-specific type facts. So you have a team of people, including a few experts that know the exact business of the target.
And how does if we back up another step, that the PE, the fund, carried interest and so forth, how is the fund structured with the limited partners?
So the limited partners are paying a lot of fees, and the fees have a couple of primary components. So the component that represents the biggest part of the fee would be the fixed fee. So the fund is paying essentially a 2% fixed fee per year as a percent of assets or commitments.
Deployed capital or no?
Committed capital, and then it shifts into deployed capital over time. So that's a rather hefty fee. That's 2% is paid whether the fund is making money or not. And then if the fund is making a decent return, the fund managers get what's called a carried interest, or some people call it a performance fee, which is 20% of the profits over and above an 8% rate of return. So if the fund over a period of time has a higher return than 8%, then the profits after that are split 20% to the fund managers and 80% to the investor.
And so that's ultimately what's in it for the private equity firm, correct?
Well, you can make a fortune just getting the fixed fee of 2% if the fund's big enough. So, if it's a billion-dollar fund, the fees per year are $20 million a year, and you don't have to do anything in terms of making a lot of money to get that 2%. So you're getting $20 million a year, rain or shine. If you're beating the 8% bogey, then you could be making 50 or 100 million on top of that over time. So it's extremely profitable, particularly since a big fund like that might only have a handful of partners. The rest are just people making salaries and bonuses.
Got it. So a fund that, say, performs 16%, I know that's probably not typical, but a fund that performs 16%, so the hurdle rate was 8%. So I don't know what you call the excess there, the 8%, but they get 20% of that.
Yeah, so exactly. So you can imagine on a $1 billion fund that over, I don't know, the math is a little complex just for us to sit here and talk about it, but the carried interest performance fee on what you described might be $100 million over the course of 10 years. So you're getting $20 million a year in fees that are fixed plus a $100 million bonus. That's very lucrative.
Wasn't this kind of invented on the back of a napkin for the first deal, and then it just kind of stuck?
Well, the whole fee arrangement dates back to the 60s and 70s when private equity was called something else back then, boutique investments or what have you. There'd be very, very small funds, and prominent families would invest in these funds as a way to try to make more money. So it started off with what were called hedge funds back in those days, and it was 2% fixed fee and then a performance fee, as we discussed. But the private equity funds that began in the 80s just borrowed the fee structure from these older hedge funds.
Isn't that how Berkshire Hathaway was initially structured?
I believe you're right. I believe Warren Buffett did have a small hedge fund when he first started.
Well, very interesting.
Then he shut it down. He shut it down when the valuations of stocks got too high.
Well, interesting. Let's take a quick break, and then when we come back, we'll talk about your book, The Myth of Private Equity by Jeffrey Hooke. So let's take a quick break, and then we'll be right back.
The most important business transaction you'll ever make may be your last one, when you sell your company. So don't go it alone. Work with an organization that's made it their business to sell businesses, and that's all they do. Visit morganandwestfield.com. At Morgan & Westfield, we know that selling your company isn't something you should take lightly. It can be a stressful, difficult, emotional process. That's why it's important to work with a team whose one and only specialty is selling businesses throughout the United States. Don't leave one of your most important business transactions to chance. Visit morganandwestfield.com to schedule your free consultation today.
All right, welcome back to M&A Talk with Jeffrey Hooke, author of The Myth of Private Equity. Why the myth?
I was in the business, investment banking and private equity for many years, and I've done a fair amount of pro bono work for taxpayer groups and citizens groups. And so when I had this university position, I started doing some research into private equity, more out of curiosity than anything else. I was always skeptical. of the private equity industry's claims. So I decided to investigate it, and that's eventually what led to this new book, The Myth of Private Equity. I've written a few other books on finance topics, but this book is essentially an expose of the private equity business, and that's why I think it's of interest to a lot of different people.
And yes, you have a couple of your other favorite books that personally I want to plug. M&A, A Practical Guide to Doing the Deal, published by Wiley, and one of my favorites, Security Analysis and Business Valuation of Wall Street, also published by Wiley. So The Myth of Private Equity, who is this particular book written for? Who's the audience for this book?
The audience really is a combination of practitioners, people in the lending business, the investment banking business, private equity industry, obviously. That would be one audience, so the trade, so to speak. The other audience would be people that have heard about the private equity industry. You hear about it a lot in the newspaper and the media, and just have a general curiosity about it.
What's the principal message in the book, if there is one?
The principal method in the book, or say motive of the book, is to unveil the unsubstantiated claims of the private equity business. I mean, sure, a lot of your listeners think from what they've heard in the media that the private equity business is the best thing since sliced bread. But the fact of the matter is that the private equity industry hasn't really outperformed the public stock market for many years, and it's living on its reputation from some of the outperformance it had 20 years ago. So you've got a business that gets a lot of plaudits from the media and other observers. These plaudits are totally undeserved. The returns simply are not there.
And does this apply to venture capital funds as well?
Well, the book is not about venture capital, but I can tell you that the venture capital business in the aggregate does not really outperform the publicly traded stock market. So you have the same problem with the VC business that you've got with the leveraged buyout business. You as an investor are probably better off just buying a public stock index fund.
So couldn't we look at it the other way, that the public markets don't outperform private equity? And we should just get rid of all public companies and they should all be owned by private equity firms?
You could look at it, but that's inaccurate. So the public markets, the S&P 500 or whatever index you want to pick, does better than the private equity. So it should be the opposite way around. These big institutions like pension plans and university endowments should junk their private equity assets and just substitute public stocks.
Well, that's a good point, because if we're talking about public equity, we're talking about a liquid investment, perhaps lower risk. And I know for the limited partners, it's what, a 10 or 12 year capital commitment? Is that correct?
Exactly. You as a limited partner are stuck with it. So whether it makes money or loses money, it's very tough for you to sell your limited partnership interest. Whereas if you get tired of looking at your Exxon stock or your Amazon stock or your General Motors stock, you can sell it the next day.
And there is a secondary market for those interests now, right?
Very tiny. The secondary market for private equity is a small, tiny fraction of the total value outstanding. It might only be 1 or 2% per year that's traded, so it's minuscule.
So why PE?
Again, the major institutional investors are hoping against hope that their PE investments will beat the public stock markets. Now, as I said, the facts show differently. So one of the things that the book points out, and I get a lot of questions, is, okay, if private equity does not beat the public stock market, why do the big institutions continue investing in it?
Tell us. They must be smart. If they're running a $20 billion fund, there must be some pretty smart people that are running that fund.
Totally agree with you. They're very smart people. And they're very smart about making sure that they maintain the career. So there's a few reasons, and this may sadden some of your listeners who think these big institutions are run by the top Wharton and Harvard MBAs who are doing the right thing. But they invest in private equity and hedge funds and commodities and other exotic instruments in an attempt, as I mentioned earlier, to beat the public securities. They don't do it. They don't really do it. So why do they keep throwing money at these exotic investments? Well, you got to look at it from their point of view. If you're a big institutional money manager and you're just indexing your whole portfolio to get the most return, the board of trustees will say, okay, you're indexing everything. Yeah, what do I need you for? Why am I paying you $3 million a year if you're just indexing everything? So the $3 million a year manager is going to say, well, I can't just index everything, so I have to do stuff that's really complex and complicated to make it look like my job is really exacting, and you really need to be smart about it. So they're going into PE and hedge funds and all these exotic things that the board of directors of the pension fund probably doesn't even understand, but at least it's preserving the manager's job and compensation. So that's a big reason. The other reason, I think, for the continued popularity of these assets among the institutional managers is what I like to call the Stockholm Syndrome. So many of your listeners may not know what the Stockholm Syndrome is, but it was when a number of bank robbers kidnapped during a course of taking over a commercial bank there. They kidnapped a number of the customers of the bank for several days before they finally surrendered to the police. And over that short period of time, the kidnapped customers started to sympathize with their captors, and when the trial came, refused to testify against them. So if you're looking at these big institutional money managers, who do they go have lunch with? Big-time private equity managers, hedge fund managers. When they go to a conference in Bermuda or Palm Beach, who's sponsoring the conference? PE managers, hedge fund managers. So they gradually start to sympathize with the private equity fund managers rather than their own beneficiaries. The retirees are relying on the pension fund to get checks every month.
If it's private, how do we get information on the industry to be able to assess the returns?
Most of the larger private equity funds report their investments in a general sort of way, as well as their returns, to several private equity fund databases. And these databases then crunch all the numbers and provide what are the returns and provide some general information on the underlying investments. So for an average person trying to access that data, you can. It's all paywalled. And the subscription fee is about $25,000 per year. So that leaves that out. So it's always tough to get the kind of information you need on a lot of the returns and the funds themselves. Of course, the thing that no one seems to mention is that even with these expensive databases, only about 60% of the funds report to the databases. That means 40% are out there in total darkness. We really don't know whether these 40% beat the market or do not beat the market. My suspicion is they don't. Otherwise, they would publicize how well they're doing.
We've got, what are there, 4,000 public companies?
4,000 actively traded public companies, and there's probably another 10,000 that might trade 5 shares a day or something small.
And so there's 4,000 PE firms. Say there's 3 active funds at a time. So what, another 50,000 owned PE companies, roughly? 50 to 100,000, if you had to guess.
Well, the statistics on just the leveraged buyout industry suggests around 7,000 or 8,000
Got it.
companies owned by private equity. A lot of the private equity firms that are that are out there have sold off a lot of their investments, so they might be only operating with 2 or 3, and then there's, of course, the newer ones might have 10 or 15 deals. So you're probably around 7,000 or 8,000, according to, say, the Milken Institute, which tracks this. And then, of course, there's all the venture capital companies, which we're not including.
Right. So you couldn't necessarily, I'm just taking a step back and looking at this at a very high level economic perspective. You couldn't necessarily take a step back and look at the performance of the 4,000 public companies versus, say, the 8 or 10,000 private companies, could you? Because with leverage being involved, that's going to distort things a little bit. But what are your thoughts on that?
Yeah, it's tough to do an apples to apples without leverage, but we do know that with leverage, that the leverage buyout industry does not outperform the public stock market. So we know that much if we believe the values they put on all the investments they haven't sold yet. So, most of their investments they haven't even sold, so they're sitting there in inventory. But if you believe what they say their investments are worth, they're slightly below the public markets. If you want to do an adjustment to try to do an apples to apples, comparing low debt publicly traded stocks to low debt private equity, there are people that have attempted to do that. And so if you take out the effect of leverage, the return to the limited partner private equity fund would be correspondingly reduced.
Wouldn't it still be difficult to do an apples to apples comparison here, because public companies probably would be expected to run a little bit more efficiently and better access to capital and so forth? But I guess you're right. You have the other flip side of the coin, that the private firm is unconstrained by short-term results and so forth.
Yeah, I mean, a lot of people, and I'm not one of them, would argue that a lot of public companies, they're so, as you point out, they're so focused in on quarterly results, they're not looking at long-term value, and that the top managers are a little worried about taking on a lot of debt, and so they run the company in a more conservative way. And so there's a lot of theories about the efficiency of a publicly traded vehicle versus a private one. But I'd certainly agree with your comment that the cost of capital for a publicly traded company is a lot less than it is for a private one.
What do you think the difference is there?
Well, I'd say it's got to be several percentage points a year.
Substantial.
And look at the trading values of a lot of public companies. They can raise money with a very high valuation, where it's a little more difficult in the private sector. I mean, you're seeing a convergence where a lot of private companies are raising huge sums. You read about it all the time, all these billion-dollar unicorns. So there is a blurring of the two.
Why would a limited partner, if they stumbled on, the Warren Buffett of the private equity world, wouldn't they want to keep that a secret, keep it to themselves?
Yes, I think they would.
How do you think that could potentially distort? And I'm certainly not defending private equity here, but there's multiple sides of the coin here. How do you think that could distort the results? Do you think that they would report that or not report that? Same thing with the underperforming funds. Do you think that would go unreported?
Most of your big state pension plans are going to have some public disclosure about how well their portfolio of funds is doing. So there's going to be some public disclosure. A lot of, as I said earlier, a lot of private equity funds do report to the databases. But you're correct. There could be a number of funds that, for whatever reason, don't work with state pension plans, and therefore their results are not public, do not report to the database. There could be some of them. I mean, the problem they'd run into is if that secretive fund wanted to get a lot bigger. There's only so many university endowments or sovereign wealth funds out there. So if they wanted to, say, start getting bigger in the $1 or $2 billion category, they'd have to give out more information to recruit those kinds of investors.
Very interesting. Where do you think PE will be in 50 years?
I think in 50 years, the PE industry will be smaller, because I think over time, the sizable institutional investors will see the light, and they will realize that, something, we could do better by just buying a stock index fund rather than paying these huge fees to the private equity business. Now, as I said, there's a lot of big institutional money managers that are resistant to that notion of buying into public stock index funds, because it's going to jeopardize their own jobs. But over time, I think the board of directors will gradually realize that these private equity funds are not what they're purported to be. The results are not really very terrific at all, in fact, mediocre. But it takes time to turn around the Queen Mary. Private equity business has a lot of momentum. They've got a lot of protectors. They have an entire protective ecosphere, which pretty much validates their claims. And so it's going to take at least 10 or 15 years for the facts to come out.
The negative opinion towards private equity from some business owners. I don't want to sell my company to a PE firm and have them fire all my employees and run this place into the ground and just focus on money. What is the correct perspective as an entrepreneur towards private equity?
Well, the description you just described of private equity behavior being that mercenary, I think is exaggerated. Yeah, there's a handful of deals where that takes place. But I think in the majority of times, the private equity fund that buys a company with a lot of debt has the full intention of maintaining the business and growing it, and then selling it in a few years at a hefty profit and keeping the business intact. I've heard a number of private owners, when I worked as an investment banker, say that sort of thing. I mean, usually after going through the hiring and exhaustive sale process of their own companies, they usually say, to heck with it, I don't care about my employees, I'm just going to sell to the highest bidder. And so whatever negative thoughts they had about private equity tend to disappear in the process of selling the business. But rest assured that I don't know, negative stereotype is not valid in most of the cases.
What does an entrepreneur need to know about selling to a private equity firm?
I think the entrepreneur needs to know that the firm has success in not only closing deals in a proper manner, but also developing the companies to have greater value over time. That would be what I would do as an entrepreneur. Will my company be in good hands over the next few years? Now, a lot of entrepreneurs will step out of the picture. They might only work for the company for another year or two after it's been bought out. And some may leave relatively quickly. But if you're an entrepreneur of the mind that I'd like to see the business continue in a prosperous manner, they just really have to look at the track record, the PE fund, and see that it's able to grow and eventually realize more value from the companies they bought.
How do you do that? How do you look at the track record?
Well, you would simply ask the private equity fund, can I look at a list of all the companies you've bought over the last 10 years? And then you can do a search or talk to the managers of the companies that they bought and say, well, how were things going? Or you can look at the evidence. Who did they sell to? Did the companies go bankrupt? So you got to do a little tire kicking on your own, or of course, if you have an investment banker representing you, you can ask the banker to look up those facts.
What at a minimum would you say they need to know about the PE firm? Their industry specialty, their size, target, the various other mandates in the fund, how many funds they've raised, the size of the fund, what do they call it?
Vintage year.
Vintage year, yes, and so forth. What's a minimum they should know about that PE firm before they sit down and have a potential meeting?
I think if I'm selling my business, I want to know, is my company the right size for the fund? So if you've got a mid-sized company that's worth $30 million, I mean, you'd prefer to sell the private equity fund in the mid-market size, which might be 200 or 300 million, so that your company is going to get the right attention.
Meaning that the fund size is 200 to 300 million?
Yes. So they like to do deals in your category, so you're going to get the right amount of attention from the managers going forward. I mean, the other thing, as you mentioned, is industry specialty. Most PE funds would tend to be agnostic on specific industries, but I think it would be helpful to sell to a fund that has done a number of deals in your sector. Do they have to be specialists in software if you've got a software company, a low-tech software company? No, but over the last 10 years, have they done 2 or 3 deals in the area so they know the basic economics of the business and how it works? So that would be helpful as well. And then maybe the last factor would be personality. So you as a investor, entrepreneur, if you want to call it that, you're an entrepreneur, you've got this company, or maybe it's a family business, and you're selling to these managers, and you see that they have the right size and they do have some industry fit. I think you want to talk to them and see, does your personality and your management style mesh with theirs? You're going to be living with them. You stick with the business for 3, 4, 5 years. So from a personality standpoint, you want to make sure you get along with them.
Well, let's take another quick break, and then when we come back, we'll talk about just that. You mentioned they'll have to stick around for 3, 4, 5 years. Some entrepreneurs might not be aware of that. So again, let's take a quick break and we'll be right back.
Thanks for listening to M&A Talk, sponsored by Morgan and Westfield, a nationwide leader in business sales and appraisals. Our goal is to provide you with insight and guidance on how to build your company's bottom line and maximize value for eventual sale. To view the show notes on this episode, including contact information for our guest and links to resources we mention in the show, please visit morganandwestfield.com. If you are enjoying this episode, don't forget to subscribe and leave a review. And now, back to today's conversation with your host, Jacob.
All right, welcome back to M&A Talk with Jeff Hooke, author of The Myth of Private Equity. So Jeff, sticking around 3 to 4 years, why would the PE firm need the entrepreneur to do that?
For the leverage buyout business, you've got to remember that a lot of the customer relationships, a lot of the marketing, a lot of the operations have been developed over 15 or 20 years. And it's highly likely that the private equity fund is going to want the managers, at least a number of them, to stick around for 1 or 2 years to smooth the transition. Others may want you to be there for a slightly longer time. And so, particularly for the low-tech buyout businesses, you're going to look as a former owner or former top management, you're probably going to be looking at a 2-year commitment. So that's something they got to be prepared for. You just can't walk away the day the deal closes. That's not what the PE fund wants. And the PE fund may very well want you to sign a non-compete agreement for a couple of years, which means that if you do leave your low-tech software business, you sign an agreement with the PE fund not to enter another low-tech software business for at least 2 or 3 years.
How common is it for the PE firm to replace the owner or CEO?
I think it's quite common once the transition period's been exhausted. Once a couple, 3 years have gone by, it's not unusual that the PE firm says, look, this manager or a former owner was good in running a $30 or $40 million company. Now that under our tutelage, it's grown to 70 or 80, we just need a new kind of manager. So it's not unusual for the older managers who were with the company in a different form to be eased out. Nothing negative or reflecting badly on the former managers. It's just that the company has evolved. It needs new types of operations.
And how might the compensation for the CEO work? So let's say you've got a $100 million company with a $10 million EBITDA, and the PE firm just bought that company. How would they compensate that CEO that's accustomed to making $10 million a year?
Well, if the CEO is also a former owner, part of the compensation is going to be tied to a roll-in of that owner's prior equity. So let's say after the $100 million deal is closed, the former owner or former manager gets $30 million of that 100. It's very possible that the PE fund might say, okay, you're getting $30 million in cash. We'd like you to take $10 million of that 30 and reinvest it into the highly leveraged business. So that's part of the compensation there. Hopefully there's some capital gains on that roll-in investment, or rollover, some people call it. The other thing would be that the CEO is going to be getting a normal market salary. So it's not getting some outside salary that perhaps the executive had in a family-owned business or its own business. So you might be getting a normal salary of, say, $700,000 or $800,000. But there's often a stock option package included in that. So the $100 million deal, it's got maybe $25 million of equity in it. The top executive, along with maybe his or her team of, say, top 7 or 8 executives, might get options to buy 10% of that $30 million of equity at a bargain price.
And how might that transaction be structured? So are they essentially in that situation, is the PE firm buying 70% of the shares of the company?
Yes. I mean, mathematically, the PE firm might buy 70 or 80% of the shares, and that would leave the existing owners who did own 100%. That would leave them with 20 or 30% of the highly leveraged company. So they've taken cash out for sure, but the PE firm is saying, we'd like you to have some silver handcuffs. So we're asking you to show your confidence in the business going forward by rolling over some of your cash proceeds into the new business.
For the CEO, why might they call that a double dip for the owner?
It's a double dip because the owner first cashed out when the PE firm took over the business, so got a big bunch of cash in the first transaction. And then if the owner did a roll-in or rollover and, let's say, owned 3 or 4 million of the stock in the new highly leveraged business, and that business was sold in 3 or 4 years, then the owner got the first cash amount, and then when the business was sold a second time, got the second cash amount. But you've also got some owners who stick around for 2 or 3 LBO transactions. So not only they're double dipping, they're triple or quadruple dipping.
So meaning each time the company's sold that they stay on as the operator?
Exactly. A good friend of mine was a CFO. He went through like 3 LBOs already, the same company.
Why would they do that, by the way?
Well, he wasn't that old. He is making money off each deal. What's the point of leaving? I mean, I guess he could retire and hang out on the beach. He doesn't like to do that.
So what, on a $100 million deal, what might this look like for the owner? Let's say they sell 80% of the company now for $80 million, and they roll over X amount of equity. What might a single or a double and a triple look like if the company's resold in 5 years for the owner?
Well, the owner, as I said, will probably keep, let's say, they'll keep 20% of the LBO business. So the initial proceeds might have been 20 or 25 million to the owners, plural, and then now they have a smaller equity base in which they invest.
Would it be 20 million or 80 million if they sold 80 million of the company?
No, they'd sell 100. They'd sell for the full 100. But the reinvestment number would only be 30. The 100% of the equity would be 30 million because the debt was 70 in the new deal. You got 70 of debt and 30 of equity. So usually the LBO firm's not going to allow the former owners to own more than, say, 30% of the new equity.
Okay, so it's not 30% of the entire company. It's just 30% of the equity portion.
Right. So let's say it was 30 million of equity. 30% of that would be 9 million that would be held over by the former owners.
So on a $100 million valuation, would they initially take out 80 million?
Well, if the company had no debt, if the target had no debt, the former owners would take out 100. And then they might be asked to reinvest 9 of the 100.
Got it. Okay.
So they've got 90 left over. But of course, it might have been a family-owned business where the brother-in-law that was actually running the company only had a few percentage points or 10 percentage points, and maybe he didn't get the whole 100. He only got 10.
And so on that 9 million, what might a single, double, and triple look like in 3 to 7? 3 to 7 years is the typical holding time, correct?
Yeah. So the optimal or the objective of the private equity firm would probably be to double that 9 after 5 years to 18. That would be their sales pitch to the seller. We think that your 9 can turn into 18 after 5 years. So that's roughly a 15% rate of return.
And would you call that a single or a double?
No, I would call that a double.
A double. Okay, so you're doubling it, which is a double. And would that essentially match the performance of the PE firm as well for that particular investment? Would the return of the owner match the return of the PE firm?
No, it wouldn't be an investment in the entire PE fund. It would only be the investment in that one company. So on a single company basis, you've got 1 or 2 that might be a triple, then you've got 1 or 2 doubles, and the rest would be singles or strikeouts. So from the former owner's point of view, when you roll in that 9 million, you've got a 30-40% chance of getting 0, another 20 or 30% chance of getting 8%, and then the others, you'd probably look at a pretty nice return.
How is that equity arrangement structured? Is it structured similar to a VC investment where you have all sorts of restrictive covenants and so forth, and certain minimum returns that must be met before the owner receives any sort of return on their capital? Or how is that typically structured?
Well, they'd have a management contract where, there'd be certain carrots that have to be attained or certain objectives before, they get these bonuses or stock options. So, there'd be some performance measurements they'd have to fulfill to get the maximum return.
What might some of those be, like the liquidation preferences and so forth? And what should the owner know about those potential arrangements?
Well, this is a highly technical area when you talk about liquidation preferences, but I'll just try to provide a basic summary. A lot of private equity funds will take their equity in a what's called a convertible preferred stock. So, the terms of which have to be read very carefully by the former owners. But the convertible preferred stock might get what's called a preferred dividend that's in front of the common stock holders. And of course, preferred stock in bankruptcy has seniority over common stock, and the preferred stock may have super voting rights. So usually the PE funds in a slightly better position return-wise and voting-wise than, say, the common stockholders. So the small business owner that's thinking of selling to a PE firm has to look at the fine print.
And you think it's likely they're going to understand all this jargon, or are they just going to pay their experienced M&A attorney to negotiate it for them, and in 5 years they're going to end up getting a check and not really know how it's calculated?
I think most of them will have an experienced M&A attorney that will be able to translate those voluminous documents into plain English. I mean, there's only a handful of pages in an M&A contract that are not boilerplate, so your attorney can guide the client through that.
So again, very, very complicated situation. Sounds like it's somewhat similar to a VC investment with, like you mentioned, convertible preferred stock. Angel investors often use that structure, VC investors and so forth. And if you want to roll your sleeves up and get a book on that, it's like Jeff mentioned, it is very complicated. What else do you think an entrepreneur needs to know about selling to a PE firm?
Just be sure that they are the right fit, both from a financial point of view, industry point of view, and personality point of view. I mean, the PE people aren't necessarily bad people, but they're going to do their investigation of you as a seller, and you as a seller have to investigate the buyer. It's a marriage. Maybe you could say it's a marriage of convenience, but it is a marriage. You got to know your partner.
Is there any reason not to sell to a PE firm? Say you had a buddy that you golf with and he had a bad experience. Is that just anecdotal, or is that something you think they should take into consideration and perhaps avoid selling to a PE firm?
No, I think it's anecdotal. I think if a seller is unable to get a higher price from a competitor, a strategic buyer, the PE funds are good options. Yeah, you're going to have some bad experiences you hear about. I would imagine the experiences are probably generally positive, but yeah, you're going to have the occasional bad apple in the barrel.
So what's the main difference between selling to a strategic versus a PE firm?
Strategic buyers are usually going to be buyers that are in the same exact industry as the seller. So they would have their own team of operating managers, and they're going to have an intimate knowledge of the business. So for the most part, the seller managers or owners, I mean, they certainly won't be needed after a year or so. I mean, they might try to fit in with a buyer, but they're really going to be duplicative and probably not needed. So when you sell to a strategic, you got to be aware of that fact.
So if you're selling to a PE firm, you pretty much need to plan to stick around for, a minimum of 2 to 3 years?
I think that's generally the case. Again, all companies have their own unique facets, and so do PE firms, the way they like to do business. But that's a reasonable expectation.
So we've talked about a lot in the show. We've covered many, many aspects of private equity. Anything else that you'd like to cover that you think a business owner should know about private equity, how the industry works, and potentially selling to a private equity firm?
Well, I think a lot of middle market companies are going to find private equity funds to be the best buyers. They're going to offer the highest price. They're going to have some knowledge about your business. They probably won't be experts like your competitors. A lot of the competitors may not be in a buying mood. So a PE fund, particularly for a middle market, is going to be a good option. They'll probably offer a reasonable price, and hopefully you get along with them. From an investor's point of view, if I'm an investor or, say, an entrepreneur that's cashed out and I've got $50 million in my bank account, I would not advise investing in a PE fund as a limited partner. I don't think it's a attractive investment compared to the public markets. But from an operating point of view, if I'm selling a company, I think a PE fund would be a very logical buyer.
Why can a PE firms afford to pay sometimes more than strategics? Is it just when interest rates are low, or what other factors might be at play here?
Well, a lot of times the strategic buyers have a multitude of reasons why they're not in a buying mood. They may have just bought something else. Even though you think, boy, this is a perfect fit, they may say, well, we don't like the target's customer base, or we think their technology is a little outdated. So I've worked with a lot of strategics, and I'm puzzled why they don't want to buy certain competitors that seem to be a perfect fit. So you can't be a mind reader as an investment banker or a seller. The strategics, there may be half a dozen of them or 15 of them. They're not displaying the appropriate level interest. If you've got the kind of low-tech money-making company we've described, I think the PEs are a great alternative.
Some of the owners in the lower middle market, I know, are just completely caught off guard when the PE firm submits a letter of intent and then spends hundreds of thousands of dollars conducting due diligence with their army of specialists. And then they receive the purchase agreement that might be 50 plus pages long. And that might cost $50,000 in legal fees to negotiate. How prepared should an owner be selling to a PE firm? Is this going to be a walk in the park, or is this something where they should really build up their team of attorneys and accountants and other specialists and be prepared to spend some serious money negotiating this transaction?
Well, if I'm a seller, there's a couple of things I think sellers ought to do. Does this mean with all the sellers I've worked with, they do it? Most of them don't. But number one, before you jump into the shark tank, you as a seller should get an independent appraisal of your company. So you actually know what the logical price is going to be. You're not wondering, what am I going to get out there? So if you think the appraisal is too low, maybe you shouldn't sell your company at all until the value has gone up. So that's the first thing they ought to do. Second, after getting appraisal, or perhaps even before, I would suggest that a seller get a couple of books on the M&A process and get a little bit of background and some good knowledge. Not an academic book, but a book written by a practitioner who kind of lays it out step by step so you know what you're getting into.
And what's the importance of hiring the right attorney? And what do you think that might set an owner back?
Well, every big city is going to have a variety of law firms with M&A experience. They've seen all these documents a million times. So if you get to the point where a possible PE fund buyer has put a letter of intent in front of you after doing some tire kicking, visiting you and getting some information back and forth, if you've actually got a letter of intent that has a nice number on it, then you should hire a lawyer. I don't think there's really any reason to hire one much before that. And then you can have that lawyer go through each paragraph of the 4 or 5 page letter of intent and make, kind of help you decide which parts of it seem reasonable and which parts do not.
Well, wonderful. Any final words of wisdom here, Jeff, for whether it be an entrepreneur listening to the show, whether advisors or anyone else interested in private equity?
Just be prepared that private equity may be a part of your life if you're interested in selling your business. They are growing. They're doing lots of deals. And I don't think they're going away in the near future.
Well, wonderful show. Good advice. What's your next book after The Myth of Private Equity, by the way?
When I wrote my 4th book, I said I'd never do it again.
And you did. I'm sure you have more planned.
We'll see about that.
All right. Well, I'm very curious what the next one will be. So you've got 5 other books. If you pull up Jeffrey C. Hooke with an E, Hooke, And if you go to our show notes page on our website, morganandwestfield.com/podcast, and pull up Jeff's show here, we'll have links to all those books and links to his website and LinkedIn as well. And again, the title of his most recent book, The Myth of Private Equity, published by, was it Columbia?
Columbia University Press.
Right, available on Kindle and hardcover. And again, Jeff, we appreciate you coming on the show, and we hope you join us on a future edition of M&A Talk.
My pleasure. Thanks for having me.
M&A Talk is brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. If you've enjoyed this show, don't forget to subscribe and leave a review. Learn more at morganandwestfield.com. While we take reasonable care to select recognized experts for our podcast, please note that each podcast presents the independent opinions of such experts only, and not of Morgan & Westfield. We make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. Any reliance on the podcast information is at your own risk. The podcast is for general information only and cannot be considered legal or professional advice.